Welcome to the Chiro Money Show, where we're helping chiropractors make better financial decisions so they can build stability in their finances and a lifestyle that they love. I'm your host today, Scott Campbell of Align Wealth. We got our first solo pod today. Chris, he's away right now, enjoying some time still in New Zealand with his family. He's gone for pretty much the entire month of November. He'll be back with us next week. For myself, I just recently got back from the CNAC Fall Conference in Toronto. Met some really great doctors down there. Even had a few come up to me and say, hey, been listening to the show and have been enjoying it. So really great to hear that we have more than just our spouses and children listening in. And I say children because, true story, last week, 2 separate occasions, 5 and 7-year-old, my kids, both at one point said, hey, jumped in the car. Can we listen to the Chiro Money Show? That doesn't last too long. By 10 minutes in, they say, hey, can we switch gears here? Play Golden by K-pop Demon Hunters. So we do that. But still, nonetheless, they're committed to the show. So anyways, topic for today. Most people, I think, feel that successful investing comes down to picking the right stocks, timing the market, or finding the next big thing. But the data is abundantly clear that your behavior matters so much more than the actual investments that you choose. Investments that you choose are important, but your behavior matters so much more. So today, we're going to discuss some of the most common biases and behaviors that we so often see and how they can have a negative impact on your long-term investment journey. And of course, we will leave you with some ideas to consider as well. So let's give you first and foremost a stat that I know had a fundamental impact on how I viewed investing. Because I know when I was younger, before I became a CFP, I also thought that successful investing had everything to do with skills and in particular, picking the right stocks to own. So let's talk about what is called the behavior gap. So the behavior gap is simply the difference in total return between what the investment returned, the actual product that you own, versus the return the investor actually earned from said investment. An independent research firm called Dalbar, they're best known for analyzing investor behavior. They've shown that over the last 30 years, the average equity investor has earned approximately 6.8% per year, while the market, and in this case, the S&P 500, so for context here, in case that term is new to you, the S&P 500 is the 500 largest companies in the US. The S&P 500 has earned 9.65% per year. That's a 2.8% performance gap purely due to our human behaviors. The biggest drag on your investment returns isn't the market, it's us. And when I say us, that could potentially be the individual touching and making poor behavior-based decisions with their portfolio, but it can also be poor advisor-based decisions. Because often investors lean on advisors to make investment decisions on their behalf. And there are plenty of advisors out there who are also prone to these same biases and common behaviors that we're going to dive in and talk about today. First and foremost, fear and greed, they often drive most poor decisions. Buying high when we're excited and feel opportunistic and optimistic about the market, and selling low when we're feeling scared and feeling bearish about what's going on in the market and in the news. And underneath fear and greed are a handful of predictable biases that every investor can potentially fall into at some point during their investment journey. So we need to talk about biases. Biases aren't character flaws. Biases, they're hardwired into all of us. We can't eliminate them, but we can recognize them and build systems and the right portfolio to help ideally kind of push them out of the way. Before we dive in, we're going to talk about from a high level, kind of a short and simple list here of the most common biases that we see. And then we're going to tie in some real conversations that we've had recently to kind of bring the real life element into this and share some actual examples of conversations that we had and point out some of these common biases that we so often see. So here's the short and simple list that we're going to kind of dive in and talk about on this episode. Number 1, overconfidence bias. What that basically means is thinking we know what the market will do next and having some degree of confidence that we know what's going to happen. Number 2 is recency bias, believing the recent past will repeat itself. 3, confirmation bias, seeking information that supports our existing beliefs on a certain product or investment. 4 would be herd behavior, following what everyone else around us is doing. We're naturally in positions sometimes where we surround ourselves with friends or coworkers or peers that have their own ways of investing or advising. And because they're in our environment and they're in our circle, we often will trust them and follow the herd in a lot of cases. Number 5 is sunk loss fallacy, holding losers because selling feels more painful than cutting our losses. Number 6 is loss aversion, which basically means losses, they hurt more than gains feel good, right? Gains feel great, but the losses, they hurt and they cut so much more. And lastly, number 7 is a home country bias. It's very common for Canadians. We're going to dive into this a little bit, and it's overweighting your country's market. So let's start out with some stories here. I mentioned here on previous episodes that we've been at a number of chiropractic conferences, events here over the fall. And naturally, when folks come up to our booth and start talking to us, so often the topic quickly switches gears to investing, which I find interesting because I think it's a perfect case in point that so often people have the conception that advisors and planners, their kind of primary job or what they do for people is investment management, which it's only part of it. And from our perspective, nonetheless, always love to riff and talk about the topic of investing. So a couple of these first stories were actually with chiropractors that we met at a few of these conferences here this fall. Let's dive into the first one. The first one was a doctor who had the belief that they wanted to remain 100% invested in US equities. Equities, again, are essentially just owning stocks, in this case, in US companies. So the same stocks and equities, those are interchangeable terms. So he had already been invested in US equities for a number of years. And when I asked him about what he sees in the future, he says, you know what, for a lot of reasons, the US has absolutely been crushing it. They've been doing great, which is true. Over the last 10 years, the US broad US market has done about 14% per year, where Canada, for context, has done closer to about 11.75%. There's a bit of about 2.5% difference in terms of total return from US to Canada. And from his opinion, he felt very strongly that that was going to continue to repeat itself. And 2, he was also very tuned into political news and felt very strongly that making a decision to invest any money into Canadian equities was far from a good idea. There's a few biases here. One would be clearly overconfidence from my perspective. He is overconfident and has some recency bias as well, that what the US has done in terms of performance and total return is going to be the same thing that's going to happen in the next decade ahead of us. He's also confident that geopolitical news is going to play a factor, which they don't always correlate. But what's interesting here, if we just look at 2025 alone, Canadian equities, Canadian stocks have actually been outperforming US equities. And I'm not bringing that statistic up to say that you should be investing more in Canada than the US. But what's interesting is that he has a lot of overconfidence and recency bias. He probably has confirmation bias as well. He's probably getting information from sources that would support his decision to be 100% US invested. But that doesn't necessarily mean that over the next 10 years from 2025 through to 2035, that the US will continue to outperform Canada. Hey, before we keep going, if you've been listening and thinking, I could really use some clarity around where I truly stand with my finances, we've got you covered. Take our free financial clarity assessment. It only takes about 5 minutes, and you'll get a personalized scorecard showing exactly where you're strong, where you might be spinning your wheels a little bit, and where to focus next. You can head over to alignwealth.ca or just hit the link in the show notes. All right, cool. Back to the show. So let's shift over to the next conversation that we had with a chiropractor at one of these conferences. And his is a bit unique, not uncommon, but he was a bit younger, and he shared that he wants all of his portfolio, almost all of his wealth, if possible, in cryptocurrency. So he shared a little bit. I think he said that he was primarily in Bitcoin. He had some XRP as well, if I'm not mistaken. And he had made a lot of money up until this point in cryptocurrency. So when you've made a lot of money over a short period of time, like to give you some context, over the last 5 years, I believe Bitcoin is up somewhere to the tune of 400%. If he's been investing in cryptocurrency for the last half of a decade, his confidence has continued to grow. His belief in cryptocurrency and this asset continues to deepen. But what we see from the outside looking in is to say there's probably some recency bias. Cryptocurrency, or maybe in this case, Bitcoin particularly, it's done really well as of late. It's going to continue to do well moving forward. Because of the ongoing kind of growth with cryptocurrency in the last half decade, he probably has a lot of overconfidence that that's going to continue, of course. My guess, although we didn't dive into the conversation, but I see it so often with speculative assets or particular asset class, is kind of this combination of herd behavior and confirmation bias as well, where it wouldn't be too hard to find a group of people, whether that's in person or online, in forums or on Twitter or X or whatever the case might be, and finding supporting evidence to say, I found my people. They also all believe in investing in cryptocurrency primarily. And everyone's telling me and confirming that my belief in being 100% in cryptocurrency is the way to go, right? And I'm not here to dispute that whether cryptocurrency or Bitcoin or any certain asset class is the wrong asset class to be invested into. But, say for example, if we just look at the last 5 years, like I said, it's been up, Bitcoin's been up close to 400%. But just in 2025, like Bitcoin itself has been very flat. It's actually, I believe, down about 5% year to date, where the broad global equity market is up about 18.5% year to date. This is recording as of the end of November, and I'm referencing Vanguard's VEQT All Equity Fund at the moment for some context here. So again, are we saying that cryptocurrency is bad and only investing in equities and the market is good? No, but by being 100% in all of one asset, be that cryptocurrency or all in the US, there's a lot of overconfidence and oftentimes recency bias that's clouding our judgment in terms of how we can ultimately have a successful investment experience over the long term. And last story that I'll touch on, this is actually from a newer client that we started working with. He had moved his portfolio over to a globally diversified portfolio, low in cost, all the things that we look at and consider when we build someone's portfolio for them. But in his case, he had a direct investing account as well, where he was still holding, I believe it's somewhere between 5 and 10 individual stocks that he had picked. I'm not exactly sure how long ago, maybe 3-5 years or so ago. And most of them had done very poorly. And in his mind, when I had a conversation about that to say, why do you want to continue to hold on to this little pocket of individual stocks? And in his mind, he is saying, I just can't get past the idea. Like if I sell these stocks, that locking in and crystallizing that loss is going to be so painful to admit that it's like I picked some losers here. And if I actually submit the trade order to sell those stocks, that's going to feel quite painful. So the biases that we see here, one would be that kind of loss aversion, like that the idea of selling is going to be so painful that he can't stomach the idea of placing that order to trade those stocks into cash and then move on with getting the rest of that cash into a globally diversified portfolio. The big one here, probably the most prominent, is the sunk cost fallacy. What I asked the client was, if you had that cash today, knowing the information that you have on hand, would you buy those same stocks today? If the answer is no, then the current idea of continuing to hold those stocks is more of a behavior, emotional based decision versus a rational decision. And then lastly here, the last bias that I wanted to touch on in this conversation today was what's referred to as our home country bias. So often when we're viewing a new client's portfolio, if they're coming over in particular from one of the big banks, I think the stats are in Canada right now that most Canadians are holding at least 50%, if not more, of their portfolio in Canadian equities. The facts are is that Canada only makes up about 3% of the global market, which is just a fraction of the overall market, right? Where with us as Canadians, it's common for us to hold a lot more of our home country's equities, right? The same thing goes for a lot of US investors. It's actually probably even more prominent in the US that for a US investor, in a lot of cases, 100% of their portfolio is only in US stocks, and they don't consider to have any exposure into Canadian equities or international or foreign markets. So when we think about designing a portfolio, we of course still want to have some exposure to Canada and Canada's stocks and companies. However, having 60 or 70% of your portfolio in a country where they only make up 3% of the global market isn't necessarily going to have the outcome that you're looking for when it comes to a return. And what the research does show is that it's reasonable to have some level of home country bias. From our perspective, that's somewhere in the range of 25 to 30% of Canadian equities in your portfolio. But again, one of the most common biases that we see is Canadians having way too much exposure to Canadian equities in their portfolio. So where do we go from here? Let's shift towards kind of takeaways. What can you do with this information? I'll kind of bullet point these in terms of things that we think about in terms of ultimately designing a portfolio and having the right systems and kind of thought process to ideally recognize when we have these biases and ideally put you in a position where you can have a good outcome over the long term when it comes to your journey as an investor. The first one that I'll point out is the goal isn't to beat the market. In our opinion, it's actually to get the market return. Like I said earlier in the show, the behavior gap shows that most investors earn somewhere between 2 and 3% less than the investments that they own. That's not a product problem. It's a behavior problem. Number 2, I think this is so important. Understanding your investment strategy. If you don't understand it, you won't stick with it. Simple beats complex because simple so often gets followed. Next, number 3, it's the person who earns an average return for the longest time is often the one who wins. Slow, steady, sometimes boring, but disciplined investors outperform those sexy, exotic, trendy investment opportunities that we hear about day in and day out. Wealth is a function of time and behavior and consistency. Number 4, be broadly diversified. And I mean truly diversified. When we say diversification, we're not talking 30 or 40 different stocks in one sector in one country. We're thinking 13,000 companies globally across every major country and sector. No predictions, no concentration bets. Number 5, we want to keep costs low. Every extra percent in fees is a percent that can't compound. Market returns are generous. We want you to keep more of that in your pocket. Number 6 is tuning out the noise. The headlines and the market news are everywhere, and most financial news exists to trigger your biases. One thing that I also say when it comes to tuning out the noise is checking your accounts less, not more. I saw an interesting tidbit on someone else's podcast the other day that I'm sure if you haven't heard of Wealthsimple is a large online robo platform where you can open up more or less a self-directed account and either get a managed portfolio or pick your own individual stocks. But they now have a feature on the Wealthsimple app that gives you kind of like a Spotify wrap up at the end of the year. And one person on this podcast was sharing that an individual checked their account 368 times that year. We oftentimes have clients that say, hey, we rarely check into our accounts. Like we might log in once or twice. And we say, that's fantastic. You don't need anything more than that. that's likely going to have a better outcome than checking into your portfolio on a day-to-day basis. Number 7, focus on what you can control. Such a big part of having a good outcome over the long term with your investing. Focus on your savings rate, focus on your cash flow, focus on your behavior and your decisions, be broadly diversified, and focus on your long-term financial plan. So I'll wrap this up by saying the real goal here is let's close that gap. Let's get you close to that investment return on your portfolio, not the investor return. That's where long-term results are built, and that's how real wealth is built. So I will wrap it up there. Thanks for joining in on this first solo pod with myself. Chris is going to be back next week. Look forward to having him back. I know we've also had some recent conversations about getting some guests on the show here in the near future. I'm not sure exactly when that will happen, but something to look forward to as well. So thank you for tuning in to this episode. One thing that I wanted to add as well is Chris and I would love to do a mailbag episode here at some point before the end of the year. And we'd love to hear from you. We'd love to hear what kind of topics or specific questions that you might have that we can have a conversation about. You can go to the chiromoneyshow.ca. Scroll down there. You can leave a question for us or a topic. And if you prefer, you do not need to leave your name and email. You can just share a question or a topic with us, and we'd love to dive in. So thank you again for tuning in, and we'll see you again next week. All opinions expressed on the Chiro Money Show are for educational, informational, and entertainment purposes only. Nothing on this podcast should be considered financial, legal, accounting, or tax advice. Always consult your own team of licensed professionals before making decisions about your finances.